Let us look at this question. Which of the following situation is least likely to produce a deferred tax liability? Now, we have already studied that deferred tax liability is created when the taxes that is recognized in the financial statements is greater than the taxes that is recognized under the tax statement. So if this situation happens, then a deferred tax liability is created. Otherwise, if the reverse is true, then a deferred tax asset is created. So let us look at all the options one by one. The revenues are recognized in the income statement before they are included in the tax return due to temporary difference. Now, once the revenues are recognized in the income statement, that is the financial statements, then my net income increases, and hence my taxes also goes up. Whereas if it is not included in the tax statement, so this tax part, which is a part of the tax statement, it is less than the taxes recognized in the financial statement. Hence it will create a deferred tax liability. So this will create a deferred tax liability, DTL. The expenses are recognized in the income statement before they are tax deductible. Now, if the expenses are recognized in the income statement but not in the tax statement, then my net income in the financial statement will go down, and hence my taxes will also go down. Whereas here the net income, since the expense has not been recognized in the tax statement, and hence my net income remains unaffected, so my tax in the tax as per the tax statement will be greater than the tax under the financial statement, and hence it will create a deferred tax asset, not a deferred tax liability. So this is the option which we are looking for, because we have been asked which of the situation is least likely to produce a deferred tax liability. Now, using a straight line depreciation in the income statement but a double depreciation method in the tax return. So if you use a straight line depreciation in the income statement, then my depreciation value is less. My depreciation value is less, and hence my net income is high, which means my taxes are high. Whereas in the tax return, my depreciation is high because of this double depreciation part, and hence my net income is low, and hence the taxes are also low. So for the financial statement, my tax is greater than the tax reported in the tax return. This is tax return, and hence it creates a deferred tax liability. And hence, so only option B is a situation where a deferred tax asset is calculated. Deferred tax asset is formed. So option B is the correct option.